I want to talk about retirement's two biggest enemies. And by the way, neither one of them is the stock market. Let's talk about these two big enemies, and that is taxes and inflation. Now, I want to discuss these two enemies and also what needs to happen to overcome them. We will always have certain things that are enemies in our life, no matter what phase of life we are in. I remember when I was a kid, my brother and I, when we were in grade school, we would walk to this school that was a pretty good walk away, and it was a fairly hilly walk. But the enemy of this walk was, as we were not too terribly far from the grade school, we would have to go past enemy territory. And that enemy territory was actually the high school. You may say, well, why was that enemy territory? Well, we were young kids, and what some older kids would do to us would be they would take our hats, and this was during the winter, and they would throw them. And it was a real pain. You'd have to go through this enemy gauntlet, if you would, just to get to the grade school. So we finally devised a plan to which we took a longer route to go to school, came in from a different direction to avoid the enemy gauntlet, if you would. So we did that to overcome it. So in life, we're always going to have certain enemies we got to deal with, but we need to overcome them. Now, in this case, we're talking about two enemies you're going to deal with in retirement. One is inflation and one is taxes. Let's start off talking about inflation. Inflation has been around for God knows how many years, a long time. But what happened in 2020 as money began to get dumped into the system and we had a shortage of supplies, we had a cocktail for inflation. Inflation is currently at around 3.5%, but we have hit as high as 9.1%, which was a 40-year high. Now, number two enemy is taxes. We are taxed everywhere we turn. Our wages are taxed. Investments are taxed. Our home is taxed. What you buy in a lot of cases is taxed. And if you're on Social Security, you may also be getting some tax on that depending on how much other income you have coming in. So tax, tax, tax. We have to deal with it a ton. So we know your retirement money is not all yours. If we take, say, $100,000 of your retirement money, maybe $85,000 of that is actually yours. Now, what happens when taxes and inflation combine together? When these two enemies join forces, what happens? Now, let's use a 3.5% inflation and a 15% federal tax rate. And let's see how this affects our money. By the way, if we haven't met yet, my name is Craig Thompson. I'm an owner at Fourth River Financial Group. We're an investment management and a retirement planning firm. I'm an owner along with Lynn and Nathan. If you do not have a fiduciary investment advisor that you're currently working with, please feel free to reach out. Contact information is in the description box below. Now, let me illustrate this by looking at some real numbers. Let's take $10,000 and invest that over a period of 5 years at a hypothetical rate of just 4.12%. Now, we're dealing with a 15% tax, federal tax, income tax, and we're also dealing with a 3.5% inflation. So what happens when we go against those two enemies is that after 5 years, we would have a little over $12,000. But you have to take into account taxes, and then also taxes and inflation would give us the equivalent of $10,000, would give us the equivalent of $10,001. So what we can see here is we pretty much, after 5 years at 4.12%, all we did was break even on our money. 4.12%, if you would, is dead money rate of return, It is just a break-even point. So what we realize here is we have to make at least 4.12 to basically just stay at even, to just break even. And that's called dead money rate of return. We're not really getting anywhere in terms of accruing wealth. Now, let me illustrate this. Let's say, for instance, you want to go down and have a nice time on the river. So you go get a canoe, and you get in that canoe, and you start paddling. And you're enjoying the sunshine, and there's a tree off to your right, and you're paddling, and you're working up a sweat. But all of a sudden you realize you're not really getting anywhere. So you check the speed of the water coming against you, and you realize it's around 4 miles an hour or 4 knots, however you want to call it in water lingo. But it's going at around 4 miles an hour. Now, you also check and find out you can only row at about 4 miles an hour. So what happens? You're never getting past the tree that's off to your right. You just keep staying in one place, even though you're rowing. And quite honestly, it feels like you're getting somewhere. You're working up a sweat. It's a good thing you wore deodorant that day. The sun's shining, the breeze is blowing. It has all the dynamics that you're getting somewhere, but you're not. You're not getting anywhere. You're staying at the same place because you're not overcoming the speed of the current. So that's very similar to our money. If we're making 4% and inflation and taxes is coming against us at 4%, we're just barely breaking even. So bottom line, you're not accruing wealth. Now let's think about this in another way. For instance, let's say you want to go buy a refrigerator and it's $1,000 today. In 5 years at 3.5% inflation, that'll be $1,187.69. So we know we need to make at least enough on our money to overcome the taxes and inflation so that I can buy that same refrigerator in 5 years that I could buy today with my money. If I'm not at least making over that 4%, then I'm not going to be able to even buy the same thing I can today. I might as well buy a refrigerator, wrap it in cellophane, and keep it in the garage if I'm not going to at least make better than dead money rate of return on my money. So bottom line, if your money is sitting in a savings account, then you're losing money. It's eroding. Its buying power is eroding over time. Now, what needs to happen to overcome dead money rate of return or break even money? What has to happen to overcome that and to accrue wealth? Well, you have to have a long-term rate of return that's after fees and expenses that's greater than dead money rate of return or break-even money of around 4.12%. So if you're making 5 to 6% after fees and expenses, then you can accrue some wealth. So you will need to, over a long period of time, be in a good multi-asset allocated portfolio that preferably has some equities in it to make sure you're overcoming dead money rate of return. And if you are overcoming dead money rate of return, then you can accrue some wealth. Thanks for watching. I hope you enjoyed the video. If you did, please subscribe to the channel and check out our next video.